Most investors put every dollar into US stocks and wonder why their portfolio crashes when America sneezes. They watch their entire net worth tied to one economy, one currency, and one government's decisions. The wealthy diversify globally because they understand something most people miss. Half the world's investment opportunities exist outside the United States, and ignoring them means leaving serious money on the table while taking unnecessary risk. Welcome back to KB Bluetree, where we help you build smarter investment strategies that protect and grow your wealth. Today, we are diving deep into VXUS, the Vanguard Total International Stock ETF. That gives you ownership in over 7,000 companies across dozens of countries. We are talking about a single fund that captures growth in Europe, Asia, emerging markets, and everywhere else American investors typically ignore. By the end of this video, you will understand why international diversification is not optional and how VXUS can dramatically improve your portfolio's risk-adjusted returns. Like and subscribe to KB Bluetree for more insightful content that helps you invest like the top 1%. Problem: here is what nobody tells you about having a US-only portfolio. You are betting your entire financial future on 4% of the world's population. America represents less than 60% of global stock market value. Yet most investors have 100% of their money in US companies. When the US market corrects, and it will, you have nowhere to hide. Your retirement account drops 30%, and you are stuck watching your dreams evaporate because you never diversified beyond your own borders. The home country bias is killing your returns without you even realizing it. Investors feel comfortable buying what they know, companies they recognize, brands they see every day. This emotional comfort costs you money. Over the past decade, US stocks outperformed international stocks, so people convinced themselves international investing is pointless. They are making decisions based on recency bias, forgetting that from 2000 to 2010, international stocks crushed US returns. Markets rotate, and the investors who only own US stocks get left behind when the cycle turns. Currency risk works both ways, and most people only see the downside. When the dollar strengthens, international stocks lose value in dollar terms. Everyone panics and sells. What they miss is that when the dollar weakens, those same international stocks surge in value. Over long periods, currency fluctuations balance out, but you capture the growth of global economies either way. Avoiding international stocks because of currency risk is like refusing to eat vegetables because you do not like broccoli. You are missing the entire category based on one variable. The real danger is concentration risk that most portfolios ignore completely. If you only own US stocks, you are heavily concentrated in technology companies. Apple, Microsoft, Amazon, Google, and a handful of tech giants represent a massive portion of US market cap. When tech crashes, your entire portfolio suffers. International markets have different sector weightings, with more exposure to financials, industrials, and consumer goods. This diversification protects you when any single sector gets hammered. Emerging markets represent the fastest growing economies on the planet, and you are missing them entirely. Countries like India, Brazil, Vietnam, and Indonesia have younger populations, rising middle classes, and economic growth rates that dwarf developed nations. Yes, they come with higher volatility, but that volatility smooths out over decades while the growth compounds. Ignoring emerging markets because they feel risky is like refusing to invest in Amazon in 1997 because internet companies seemed speculative. You miss generational wealth-building opportunities, solutions. International diversification starts with understanding what VXUS actually gives you. This single ETF holds over 7,900 companies across 40 countries in both developed and emerging markets. You get exposure to Europe with companies like Nestle and ASML. You capture Asian growth through Samsung and Toyota. You own pieces of the fastest-growing emerging economies. The expense ratio sits at just 0.07%, meaning you keep almost all your returns. VXUS currently yields around 3% in dividends, providing income while you wait for capital appreciation. The allocation strategy depends on your goals and risk tolerance. Conservative investors should hold 20 to 30% of their stock portfolio in VXUS for basic diversification. This gives you meaningful international exposure without feeling like you are taking excessive risk. Moderate investors can push to 40% international, which more closely mirrors global market cap weightings. Aggressive investors comfortable with volatility can go 50% or higher, especially if they believe emerging markets will outperform over the next decade. Here is the framework that matters for long-term wealth building. VXUS provides geographic diversification that reduces portfolio volatility. When U.S. stocks are struggling, international markets often perform differently based on their own economic cycles. This negative correlation does not happen every year, but over decades, it smooths your returns and prevents catastrophic losses. You are essentially spreading your bets across multiple economies instead of going all in on one country. The tactical approach requires patience and discipline. Most investors lack dollar-cost average into VXUS every month, regardless of headlines. When international stocks are underperforming and everyone is selling, you are buying at a discount. When they are outperforming and everyone is chasing returns, you are still buying at your regular pace. This removes emotion from the equation and ensures you capture gains whenever international markets eventually rotate back into favor. For those who want to implement AI into your workflow and advance your career, check out these videos. The Augmentation Masterclass, Human plus AI equals Career Advantage. Now available on Gumroad and PayHip, links in the description. You will love these videos. You can implement this strategy with minimal time investment. Hour 1. Research your current portfolio and calculate your international exposure. Most people discover they have less than 10% or even 0. Hour 2. Open a brokerage account if you do not have one and fund it. Hour 3. Buy your first shares of VXUS and set up automatic monthly investments. Hours 4 and 5. Educate yourself on global economic trends so you understand what drives international returns. This is not complicated. It just requires breaking out of the US-only mindset that most investors never question. The compounding effect of international diversification shows up over decades, not months. A portfolio with 30% VXUS has historically shown lower volatility than a 100% US portfolio with similar returns. You are getting paid to take less risk, which is rare in investing. Over 20 or 30 years, this lower volatility means you are less likely to panic sell during crashes, which is where most investors destroy their wealth. Staying invested through market cycles is easier when your portfolio is not moving in lockstep with US news headlines. Success story. Meet Rita, a 41-year-old software engineer who built her entire portfolio in US tech stocks. She was making $120,000 per year and investing aggressively, putting $2,000 monthly into VOO, the S&P 500 ETF. Rita felt like a genius as US stocks soared year after year. Then she started learning about portfolio theory and realized her entire net worth was concentrated in one country and heavily weighted toward one sector. The risk kept her up at night once she understood it. For those who want to launch your solo digital business, watch this video series, The Digital Freedom Blueprint. Scale your solo business to $10,000 a month. These videos walk you step by step from launching to scaling. You will love these videos. Now available on Gumroad and PayHip. Links in the description. Rita restructured her portfolio to include 35% VXUS alongside her US holdings. Over the next 6 years, her diversified approach delivered smoother returns with less stress. When US tech stocks corrected 25% in 1 year, her international holdings only dropped 12%, cushioning the blow. Her portfolio is now worth over $210,000, and she sleeps better knowing she is not betting everything on one economy. Rita did not get lucky. She got smart about risk management. She realized that protecting wealth is just as important as growing it, and international diversification is how you do both. Call to action. Your portfolio diversification starts with one decision this week. Log into your brokerage account and calculate what percentage of your investments are outside the United States. If the answer is under 20%, you have concentration risk that could destroy your wealth during the next US market correction. The fix is simple but requires action. Buy shares of VXUS and commit to building your international allocation over the next 12 months. Set up automatic monthly investments into VXUS starting today. If you're investing $1,000 per month total, put $300 into VXUS and $700 into your US funds. Over time, this builds the 30% international allocation that dramatically reduces your portfolio risk. Do not wait for the perfect time or try to predict when international stocks will outperform. Nobody knows, and trying to time it means you will probably get it wrong. The right time to diversify is always now. Review your allocation annually and rebalance when things drift too far from your target. If US stocks surge and your international allocation drops to 20%, sell some US and buy more VX-US. If international stocks soar and you are suddenly at 40%, rebalance back to 30%. This forced buying low and selling high is how rebalancing adds returns over decades. Like and subscribe to KB Bluetree for more strategies that protect your wealth while capturing global growth opportunities. If you are interested in boosting your productivity and advancing your career to earn more money, you can invest. Check out KB Bluetree, Productivity and Career Development. We share strategies for climbing the corporate ladder, negotiating higher salaries, and building skills that increase your earning power. More income means more to invest, and proper diversification means that income compounds faster with less risk. If you want to explore building additional income streams through online ventures, visit KB Bluetree Digital and Online Business Strategy for actionable steps to start your own business. Multiple income streams plus smart investing equals financial freedom. Let us build wealth together.